Hello and welcome to this week's installment of Nucleus Investment Insights. My name's Jayden and I'll be filling in as temporary host of the program. I realise, of course, I'm an unfamiliar face and voice to all of you. That's because I'm usually on the other side of the camera in the producer role. Anyway, speaking of hosts, I'm joined by Nucleus Wealth's Head of Investments, Damien Klassen. G'day, Damien.
Hi, Jayden. Thanks. Welcome aboard. Welcome
No
onto
worries.
the other side of the camera.
Thanks for having me. And also our Chief Strategist, David Llewellyn Smith. G'day, David.
G'day, Jayden.
So, our topic of the day, stagflation. We'll be covering some subtopics of that, of course. US inflation being strong, Chinese inflation being weak, except for the US, the commodities battleground that's going on, and energy crisis, some monetary and fiscal policy, and we'll cover off some home soil with Australian inflation before, as always, getting into our investment implications. So, before we start, a quick housekeeping message. As always, a reminder before we get started, if you enjoy our content and haven't already, please consider subscribing to our YouTube channel and click on the bell to be notified of when we go live or have a new webinar to watch, or alternatively, follow us on your preferred podcast platform. For those listening in live, as always, feel free to drop in your questions in the YouTube live stream chat to have them answered by our investment team along the way. So, gents, I thought we might start with a bit of background on what exactly stagflation is, and I'll open it up to you.
Yeah, sure. So stagflation, there's probably worth showing this quick slide. It's exploded in terms of the news. It's really the theme of the minute at the moment. So stagflation refers to when you've got both high unemployment and high inflation at the same time. So that in the distant past, that was thought of as something that would never happen because when you got high unemployment, that would serve to dampen demand and inflation would fall as well. But the 1970s sort of put a sword to that theory, and we saw both high inflation and high unemployment, and then that was sort of brought to a heel. But we've started to see, as you can see from this chart, this is just news mentions of the word stagflation. It very much hit the fore in the US, where we are seeing high inflation and still elevated unemployment following the pandemic. So I think I'll jump into some of the signs we're seeing in the US though around inflation. The next chart I've got up there is inflation expectations in the blue line. And I've got another chart. So the blue line is inflation expectations, and the red line is the actual consumer CPI. Now, there's, I guess, one of the key things with inflation to remember is there's a lot of theories out there about what causes it, but even central banks don't really have a good grip on exactly what's going to cause inflation and exactly what's going to make it go away. And so there was recently a paper came out from the in the US that sort of got a lot of airtime in central banking circles, where basically one of the analysts there was basically admitting that, look, there's a bunch of things they think work, but they don't know for certain, and it is unclear as to exact causes and effects of inflation. So one of the main causes people keep pointing to is inflation expectations, and they've certainly shot up in recent times. But having said that, one of the things with inflation expectations is if you look at this chart over time, inflation expectations tend to pretty much match whatever current inflation is. And if I go back, even further in time to where there was sort of massive inflation back in the sort of late 70s, you see the same effect. When inflation's high, people are expecting high inflation, and as inflation falls, expectation falls as well. It's a human beings as a crowd often have very short memories, as financial markets sort of no doubt remind everyone from time to time, and so. While inflation expectations are rising, that's not a major concern for me in terms of that. I do feel as if the that will change based on current conditions and can reverse quite quickly, as we saw in the financial crisis. You know, the inflation in sort of 2008, expectations shot up, but then came flying back down again. In terms of the actual inflation numbers coming out of the US, they're still very strong. They're going to keep being strong for a while. There's especially when we're looking at 12-month numbers. So I guess I did a quick analysis that basically said, look, if you ended up with almost 0% inflation over the next few years, over the next few months, you're still going to keep seeing annualized inflation up around 4% because you're basically cycling some much lower numbers a year ago. And the inflation that's been happening, though, has tended to be in areas that what we'd call flexible inflation or not the sticky price. So I might jump forward in one more slides to the a graph which is showing two different lines. So this is one of the Atlanta Fed in the US splits inflation into two areas. One is what they call sticky inflation, and this is things like school fees and healthcare costs and rents and other types of things like that really don't change very much from year to year. And then they've got the flexibly priced ones, which is things like your oil price and airline tickets and things like that sort of go up or down quite substantially over short periods of time. And so they break that into two series, and within that you can really clearly see that on the left there we're showing the annualized data, and you can see that that's where all this inflation in the US is coming from. It's this flexibly priced inflation, which is sort of running at 13% over the last year. And then you've got your sticky inflation, which is running closer to a little bit under 3%, which is basically where it's been for the last decade or more. It sort of popped down a tiny bit during the pandemic, but really has been quite strong over that period. A little bit above average, above inflation. Yeah, above what the average is, and then the that flexibly priced inflation has been below average for most of that period. The chart on the right is the more interesting one, though, if we're talking about seeing where things are going. So what we've done there is that's a 3-month annualized growth in those same numbers. And on that one, we can see that black line. So if you basically what it is, you take the last 3 months worth of inflation and you times it by 4, essentially to see what's going on in just the recent past. And you can see that flexibly priced inflation actually hit 50-odd% on that basis a couple of months ago, but it's come roaring back down, and now it's back down to the same level as your sticky inflation. So this is sort of one of these things that gives us the some more comfort that the inflation is relatively transitory. There are signs, I guess, in terms of things like wage growth and other things like that might end up flowing through to inflation and keeping inflation maybe a little bit higher than it has been in the past. But we're certainly not expecting a massive outbreak of inflation, and there's lots of signs that the inflation is reversing. Dave, I sort of feel I'm monologuing a bit here. I don't know if you've got some thoughts on US inflation you wanted to add in.
Well, you're monologuing so well, Damo. There's not much I can add, except, I mean, if you roll over to the next chart, we've got the Fed's GDP now numbers, which show how quickly and in conjunction to some extent with what Damo's talking about with this falling away in flexible inflation, how quickly growth is falling away in the US. I mean, even in August, we were still tracking at 6% growth. We're now down to 1%. Some of this is the Delta outbreak, but most of it is actually just the roll-off of fiscal support, which supported the economy this time last year. Excuse me, and that's really started to bite. And so, embedded in that kind of deceleration in growth, you will see a deceleration in the labour market, and so some of these prices that Damien's been looking at are likely to continue to fall away on that basis.
And I think if we go through, you know, I've got a piece coming out, you know, over the weekend, early next week, just looking a little bit more in detail at some of these different prices that have gone into here. But we saw that the lumber price was one of the first things that really rocketed up. So it went from sort of $300 a ton up to I think $1,800 a ton at its peak, and it's back down to that $300 a ton now. So it's sort of been through that cycle of
Actually, it's gone up to about $750 now.
Oh right, it's jumped again.
Yeah.
Sorry, and on
No, that's all right. But I mean, we'll come to that in our commodities section. Basically, the energy bubble has just triggered all sorts of wild stuff in commodities.
But I guess the point is, what we're seeing is these supply shortages and problems with the with transport and other factors that are really pushing prices higher. So we saw iron ore did a similar one where it sort of ran up to sort of well over $200 and then fell back again. And as same thing, I guess, Dave, bouncing off its lows. And so I guess there's this part about saying for these for a lot of these assets, do we honestly think that say producing lumber is now made a step change and people can no longer produce the lumber they used to produce it at the old cost and do it at a profit, or iron ore, you know, for example, where they are pulling it out of the ground at $20-$30 US dollars a ton? You know, does it mean that they can't possibly sell it at similar to the old prices? Or is it just so is there structurally a change, or is this is this just various issues with shortages and extra demand coming out of COVID, which is causing these problems? And then once the problems pass, prices pretty quickly go back. And we're starting to see some of the same in transport as well. So transport costs have done the same thing in terms of really rocketed up, but have rolled over and do seem to be falling back. You know, we're expecting them to end up, you know, similar to prior levels.
Yeah, shipping in the Pacific is doing that, and container prices. Even some of the semiconductor shortages are starting to ease now. So some semi prices have rolled over. So yeah, we pretty much expect these sort of artificial shortages to all.
Just quickly, guys, we've got
rationalise.
some viewer questions here, if that's a good time for them. One viewer was just asking, can you provide an update on Biden's infrastructure plan at all, and if that will influence what we're talking about today?
Yeah, it's definitely coming through. There's been a furious debate between the squad, which is, you know, like the progressive kids who are pushing
the left wing of the Democratic Party.
The left wing of the Democratic Party, who are pushing an MMT kind of program up around $3.5 trillion, on top of, what did they get through on the original package? About 600, I think.
Yeah, I thought it's a little bit more than that, but yeah,
might be a bit more. And then we have some, you know, sort of conservatives, fiscal conservatives there, who are refusing to go that far. And so it looks like the number's going to settle, you know, somewhere just above 2 trillion, maybe. And so we end up with.
And when you say fiscal conservatives, that's fiscal conservatives in the Democratic Party. We're not.
Yes.
There's no Republicans.
No,
are likely to vote for any of this.
Now, none of that matters, because they having enough numbers in the Senate. They only need to get their own numbers on side to get what is known as the reconciliation process through, which is how Trump got his tax cuts through when the Dems resisted them. And the end result is going to be 2.5 to 3 trillion stimulus, something like that. So, you know,
but it's not going to start for some time.
No, well, they'll get that through probably before year end, but you know, it's probably this time next year before you really start to see any meaningful impact from it in terms of growth. It takes a while for infrastructure stimulus to roll out, and you know, a lot of this is soft infrastructure as well. It's actually not terribly construction intensive. So, from this time next year, probably Q3, Q4, it'll definitely start contributing to US growth and probably add over the next 6 to 8 years, maybe, 3 to 400 billion. So, it could add 0.5% to GDP, more or less. And so it's material and is a very good idea. The original, actually, I think they should have just passed the original package as was. I thought it was terrific. A lot of it's very productivity enhancing. It reeked of a party that had spent a long time in opposition thinking through its ideas and coming up with good ones. It wasn't waste at all for most part, I thought. And so anyway, it's a good package. It will get through, and it will certainly contribute to ongoing US growth leadership, but not for probably a year. And it's really that 1 year interregnum that we're going to talk about today, because that presents a bit of a valley for the market to get over. So in terms of having inflationary impacts, yes, you would expect it to have some. Growth will be stronger. It'll be fiscal in nature. It tends to be a bit inflationary, though, as I say, it's well structured. So should it contribute to productivity at the margin, and that will help keep inflation in check, at least in terms of wages, which is probably the key question at this point. I mean, at the moment, US inflation, transitory stuff is coming down. Some of the sticky stuff is going back up a little bit. Things like rent and things are increasing a little. So there is a bit of a convergence where those two will meet. As Damo says, it stays high for a while longer. And then you come to the second question of will that stronger than previous US inflation, the previous cycle, even though we don't see it as a threatening levels, will it increase wage inflation and then get you into, a wage push cycle, which is what, the inflationistas are all panicking about, especially with more fiscal coming. And that is a very interesting question. It can't be fully discounted, I don't think. We've got a chart up here from the Small Business Survey in the US, which has a pretty good record of indicating leading wage inflation, although not recently and not during the sort of secular stagnation of the last cycle. And this is one of those things where we've probably pointed out many times before. Where in the last cycle, when we had Trump's tax cuts and lots of fiscal hitting a relatively constructive economy, we saw unemployment down to 3.2% in the US, and yet we still didn't get wage inflation much above. What did we get to, Damo? 3.5 tops.
Yeah.
Certainly much lower than you would expect from those levels of unemployment relative to the past. And that really goes back to many of the structural headwinds for inflation, especially wages, that we've discussed many, many times before when looking at these questions. Things like demographics, globalization, weaker unions, stronger corporations, all of these things are kind of structural headwinds for any kind of wages blow off. So although wages are looking encouraging at the moment, we think high wages are a good thing, of course. That's good inflation versus what we've got at the moment, which is bad inflation by and large. Because, rising wages tends to increase living standards as long as it doesn't get out of hand. It increases purchasing power for households and punters. And moreover, as it crimps margins for businesses, they look for ways of offsetting that, with investment, and you get productivity, which gets you into a virtuous cycle of rising efficiency and rising incomes for everybody. And this is what the nirvana economy looks like.
Yeah, and what you're talking, what David's talking about in terms of good inflation versus bad inflation is the bad inflation is the inflation that occurs and you just there's nothing you can do about it. Where and it's not you're really raising interest rates or cramping down on demand really doesn't make that much of a difference. So the gas, for example, gas prices and coal prices are a good example of that. In that people need that to heat their houses, then it's not a that's not a sign that those prices being high isn't a sign that you've got a really strong economy. That's just a sign there's a shortage in a particular area, and prices are going sky high as people attempt to actually heat their houses and stay alive.
Yeah.
Which is different to the ones where you see strong demand because you're getting good wage growth and more productivity gains, and that's sort of leading through to people buying more things or spending more money and seeing the rises coming through from that perspective.
Yeah. So the long-winded answer for that first question was basically yes. Biden infrastructure is coming. It's not particularly hard infrastructure. In fact, it's very oriented towards soft. It will contribute to productivity and inflation a little. Hopefully, productivity more than just inflation, and so it's a good thing by and large. I see it as part of the US exceptionalism of this cycle, which becomes especially paramount when we start talking about China, which we'll do next. So, Jayden, did you have any other question you wanted to ask before we went into that? Or?
Yeah, just one other. And you had mentioned at the start of your last answer MMT and the political perspective briefly, but this viewer here has just asked, besides the political perspective, can broad MMT and stagflation coexist?
I would say not. Well, not if MMT is doing its job. I mean, the MMT is basically trying to get is trying to get employment, to get you to full employment. So if you're doing MMT, you could see inflation, absolutely, but
but you are likely to see strong growth as well if you're doing MMT.
Yeah, and if it's not bringing down unemployment, then it's probably, I think probably some of the MMT guys would argue that it's not real MMT. Then it's just getting out and spending and wasting money. The idea of MMT is very much that you spend the money in order to get everyone fully employed.
Yep.
Very good. We hope that answers your question, Greg. Okay.
Okay. So is that it?
Yep.
Yeah.
Yep. Okay. So the US has some inflation settings that are calming down slowly but surely, but are looking like they will remain firmer than they did in the last cycle without panicking about it. Now we need to juxtapose this with China if we're going to kind of figure out where the kind of global inflation is going and what that's going to do to asset markets. So on the next chart we've got here, this is really interesting stuff. China's CPI, or just consumer inflation, is incredibly weak. In fact, it's out today. It just came out while we were talking, and it's at like 0.7. It's really...
Sorry, that's the annualized figure, was it?
I think so.
Right.
Yeah. Okay. It's really, really weak. But producer prices, which is, or producer inflation, which is obviously at the supply or the industrial level, where we have businesses manufacturing goods and stuff, is really high. It came in even hotter. I think it was 10.5 today. So you have this incredible,
bifurcation.
Yes, that word slipped my mind. In China, where the prices of production are through the roof, but the prices of consumption are falling, and so, I mean, the first thing that strikes you about that is that Chinese businesses obviously don't have any pricing power for one reason or another, or whether that's economic or political, and they are not passing on price rises to the Chinese consumers, so their margins are getting squashed is the first thing.
Well, or if they try to pass it on, the consumers just don't buy the stuff. So that's
Yeah,
the flip side
for
is, you go,
whatever
okay,
reason, they don't have the pricing power.
yeah.
So China has no consumer inflation, but there's crazy producer inflation. Now the primary
Actually,
reason.
can I just add as well on the consumer
Yep.
inflation? Like, China has run consumer inflation for, like, if you look over the last couple of decades, like considerably above most other developed countries.
Yep.
So it's not just a matter of saying, oh, look, it's pretty weak because it's only 0.7. It's like, well, that's one part of it, but it's also a complete reversal of the last 2 decades where Chinese inflation was be running 1 or 2% above everywhere else, and now while we're talking about the US having this huge inflation boom, you've got exactly the opposite happening in China.
Yes. So I mean, one of the reasons why the US inflation is high is actually because Chinese producer prices are high, and so all of those goods that China ships to the US have gone up in price. To some extent, just offsetting previous falls, but also new price rises. But the main reason that Chinese production prices or produce prices inflation is so high is commodities, and it is if you dig into what's driving the price rises for Chinese factories, it's hyper concentrated in raw materials. So it's metals inputs, coal inputs, steel inputs, you name it. If it's a commodity, it's gone through the roof, and that's where most of this inflation is coming from. So again, it's not in China. It's not wages either. It's not broad based. It's incredibly narrow, actually, and it's all commodities. So commodities are driving a great deal of this stagflation narrative that we've got in markets right now. And hang on one sec, where am I going with that? Yeah, commodities battleground. So there's perhaps one more point to make about China before we move into commodities in particular, and that is China's got this booming export sector that's come out of Western stimulus that's sucking in imports like crazy. The Chinese consumer is relatively weak, and so they're not causing any inflation. And the other weakness that's really developed in the last 3 months in China is its property developer shakeout. And just note this as this discussion goes on, but of course, China's property is an immense consumer of commodities. And so you have this crazy, the world's largest consumer of commodities. And so you have this crazy situation in China right now where inflated commodity prices in its supply side are going nuts, where its largest consumer of commodities is actually just coming apart at the seams, which has always crashed commodity prices in the past. Which brings us to probably the key to this whole discussion for inflation and stagflation, and certainly in terms of how it's going to affect markets going forward. And that is, right now we have commodities have become the battleground for this debate. And so there's two sides to it. So we have this booming kind of trade recovery coming out of COVID. All of it's goods-based, not services, because everyone's been locked down for so long. That's going to fade and revert to services as economies open up, and the vaccines transpire and travel comes back, and personal services and recreation, etc. And so more spending shifts back to services and away from goods. So we've had a huge kind of ramp up in goods spending. That's in part of what's driven big run up in commodity prices. It's going to come off. Sorry.
And I guess what we're saying there is, our thesis on that is that people are spending on goods because they can't spend on services. So it's people looking at their bank account and going, oh, actually, I've got a bit of extra money this month. I haven't been able to go on my annual holiday, and so I'll use it and I'll buy a new couch, or I'll, whatever the
And so
statistically needs to be.
then there's a second COVID distortion, which is some supply of commodities has been hit, just through shutdowns, border closures, etc., labour difficulties. Just some of the inputs for commodities have been difficult to obtain, and so at various points we've seen different commodities have small hits to production. So that's taken a little bit of supply out. You've had a big demand shock, and so that set commodities ablaze last year. Now what you've had coming in on top of that, and this is where the stagflation question becomes really, really interesting in kind of behavioral economics terms. You've had Wall Street come over the top of that with its financial bullshit and just say inflation is inevitable here. What you've got to do to survive inflation, and stagflation in particular, is buy commodities. Commodities are the number one asset class performer in stagflation. And
just to confirm this is what Wall Street's saying. We're not necessarily.
Yes, no,
with that.
quite right.
Yeah.
But this is like I read this research all the time, and this is the dominant narrative right now in Wall Street asset allocators and cross asset strategists, that stagflation is here and that you need to own commodities. The fact that the inflationary part of stagflation is driven by commodities is not relevant. The fact that it's not broad-based isn't relevant. So you just got to buy commodities to survive commodity inflation. So it's really this a pretty kooky circular narrative that when you look under the surface doesn't make a whole lot of sense. And fundamentally, why is there's actually no shortages of anything. As just mentioned, fundamentally there's no real shortages of anything. We've had COVID nips and tucks and booms and what have you that have distorted markets for the last 12 to 18 months. But under that, and that's created what in commodities economics that we call apparent distortions. So there are apparent shortages in some commodities right now. But when they, you can get an apparent shortage from something as simple as an inventory cycle, like it's not the fact that there is a fundamental absence of supply or a fundamentally too much demand. They're just short-term distortions that have created a little bit of scarcity that'll pass quickly. So,
and it's also this part about for some things it's like saying, oh, well, people can do so much of this per year, but if you need 10% more, then prices are going to need to go up so that we can bring some more people, bring more capital into the business, into the industry and produce it, versus ones where it's like, well, no, there's actually lots of whatever the commodity is. It just needs time to get out there. So
yes, and the critical difference.
A great example.
That's right, and so the critical difference is this is not a structural cycle or a super cycle for commodities, because we just went through one of those, and that built out the entire commodity supply chain for the globe really for the next 50 years. In everything you can imagine, from transport to ports to mines to trains to diggers, everything was in such abundance. There's so much latent capacity in commodity supply chains worldwide that it's very easy to switch a whole lot of new commodity supply back on. And so you don't need 5 or 10 years of high prices to motivate and incentivize this whole massive wave of investment. All you got to do is press the go button or flick the switch, And so, as an example of this, we've got the highest coal prices in history for thermal coal at the moment, which is, shocked the life out of everyone, and absolutely nobody saw this coming. And it's because we've got a shortage of inventory in China and a shortage of inventory in India, and it's tied to gas being short in Europe because those two compete at the raw inputs into electricity level. But China's just basically said, okay, we're gonna lift the caps on mines, and so another 200 million tons of coal will be coming out of China in the next 3 to 6 months, which will just extinguish the coal price. Now, there have been a few little supply problems for coal as well. They'll come off. So will Chinese demand. And so some point in the next 3 months, 6 months tops, thermal coal just crashes. As thermal coal crashes, LNG crashes. gas
Well,
crashes.
it's worth bringing in Russia as well at the same point, isn't it?
It is, sure. And so because LNG and coal, you can actually think of as almost the same commodity, like because they both feedstock into baseload power, and you can actually sort of switch which one you use in a lot of different uh, electricity generators. So you can switch them on and off almost
not within,
interchangeably.
sorry, just to confirm that, not within the same factory, but within
No,
the
no, no.
same electricity grid.
Yeah, grid. Sorry, and so they're interchangeable, and so they're fungible, and so they're virtually the same commodity. So you've also had a gas shortage in Europe, a big one resulting from Vladimir Putin and Gazprom deciding to gouge Europe, and it's quite complex. There's a new pipeline they're trying to force Europe to approve and get it accelerate its use called Nord Stream 2, and there's a bunch of other geopolitical factors at play in terms of where the old pipelines go, etc., etc. So that's converged with the China coal shortage, and so you have this kind of butterflies flapping their wings all over the place to create this completely unexpected and shocking energy crisis in commodities. So again, though, it's not an underlying problem. It's an apparent shortage, not an underlying shortage. And so nonetheless, the Wall Street inflationists and stagflationists are still saying you just got to keep buying this because it's creating inflation, and you can only protect yourself from inflation with commodities. And so people are buying this stuff basically because it's going up, is what it boils down to. And
it's this classic pro-cyclical, isn't it?
Yeah, it's classically pro-cyclical stuff. It's what you would call a bubble. Basically, there's a kernel of truth to it, especially in energy, where we've had some genuine shortages, no doubt about it. But once those underlying shortages resolve, and will happen very quickly, 3 to 6 months, probably 6 months tops, depending on how cold the northern winter is, then the whole thing's just going to fall apart.
Yeah. Okay. And sorry, let's just go a little bit into that, because that is where the issue is at the moment. Is that if we got a particularly cold northern hemisphere winter, whether it happens, US, Europe, or China, then all of a sudden you have a lot of extra demand for gas and coal, and so that that will push good double prices again from here.
Absolutely.
In terms of that what's the sky's the limit, because that's the part where it's like, okay, it just needs to be filled.
That's right, and that will be genuine scarcity. And at that point, you can start talking about something we're already seeing the beginnings of, which is demand destruction. Like the market will basically look to balance supply and demand by destroying demand instead of increasing supply, which means doubling prices. Yeah. So that's what equilibrium will try and work itself out. So that's quite possible if we get a cold winter, northern winter. So I'm not saying it's over. I'm just saying it ain't going to last long.
Yeah, that's right. But then the flip side is, if it's quite a warm winter and you don't have that demand for household heating that you might have had, then you can actually see this coming unraveled a lot faster in terms of the
absolutely.
So
absolutely. It could be either side of New Year, depending on how warm or cold the winter is. But it could be very short term, or because it's to some extent inventory based, that means India, China will have to restock coal, Europe will have to restock gas. That gives it a little bit of a tail when you'll have, again, coming back to this idea of apparent demand will be exaggerated for a short period because you're building inventories, but that is not underlying demand. You see, that is apparent demand. And so you will have a bit of a tail on the price pressure for that reason. So, but once it cracks, it's basically turns into a virtuous cycle, turns into a vicious cycle, because people are buying commodities to protect themselves from commodities. When commodities crash, they're going to sell commodities to protect themselves from falling commodities.
Yes.
So it's pro-cyclical both ways. And so why this is important, of course, is right now, everybody's getting a bit spooked by inflation that's quite narrow, although in the US it has broadened a little, and they're, as we say, we think that this cycle will be better than the last. And then there's Biden's stimulus coming, and all of these things come to bear on monetary policy everywhere, but in particular in the US, because that's where the strongest inflation pulse is. And so we now have a Fed that's looking at this Biden stimulus next year, looking at a tightening labor market, a recovery, post-COVID recovery that's going
Elevated
okay.
inflation. So annualized inflation that's still running at high levels and will keep running for 4
That's
or 5
right.
months.
There's pressure on it to act, and so and then you have this energy crisis that's come in that's just sent commodities nuts again. Like energy's kind of triggered a broader bid into commodities, even things like iron ore, which the fundamental circumstances of are dire. They're all going up again. So basically, it means the Fed's going to taper. So it's more or less locked in for November, December at the latest. So we're going to have. We've had a lot of tightening in monetary policy this year already, especially in emerging markets, but we're going to see more of it, and we're going to see it especially from the Fed. So you have emerging a circumstance where you'll have more strong US growth, fiscally backed. You'll have tightening Federal Reserve, more inflation there than anywhere else. And so it's not hard to reach a conclusion where you have a kind of pretty exceptional US circumstance for yields and growth and inflation. Now, we're not saying it blows the roof off, not at all. We don't think it's going to be crazy, but it's definitely an advantage, and that's the kind of thing that will boost your currency. That's added to by a couple of other factors. China, as we've discussed, has got some very, very large sectors that are in trouble. And in effect, I think China is almost in recession now. It will be that way for the next few quarters as it wrestles with its big developer shakeout. And then you have Europe, which has been going through a successful reopening, but is very attached to Chinese demand. And so it's going to get kind of cut off before it can really gather that much momentum, especially Germany. And so the ECB is going to be hamstrung, and the PBOC, the Chinese central bank, will before long be cutting interest rates. So all of this feeds into a strong US dollar, which, is very negative for commodities traditionally and typically. So what we've got here is a kind of melt up into a stagflationary moment, very much driven by COVID distortions and commodities. And at the same time, we've got these huge headwinds building towards a commodities bust. So in short, we don't really see this as any sense of enduring stagflation. It's kind of a stagflationary moment that is going to come apart as this commodity frenzy pops, a commodity bubble pops. Mown down largely by falling Chinese demand, recovering supply, and a strong US dollar. So you push further into 2022, and then you have to start asking questions about if all of those forces continue, then you might actually end up in some kind of emerging market crisis, where if China persists with its economic restructuring and it allows itself to have slower growth for a while, as it tries to shake off some of this bad lending that it's had going in property for so long, strong US and strong US dollar and falling commodities, that very much is the kind of recipe and ingredients of an emerging markets crisis that could actually then make it even worse. You can end up with a feedback loop for the global economy. Don't get me wrong, I'm not saying end of cycle, and I'm not saying this derails the US. I don't think it does, but it starts to look a little like the Asian financial crisis and stuff like that, where you could have some pretty decent busts going on within the post-COVID global recovery.
But the US still being relatively strong.
And the US still relatively strong, yeah. And
There's
you might recall that the US in the Asian crisis, the US was very strong throughout.
Yeah.
You know,
So we might maybe before we move on to Australia and where that's looking, maybe we might hit. There's a few questions, I think, Jayden, on commodities.
Yep, absolutely. So there's a question here asking, do you think the metals used in batteries or demand for those metals will stay elevated in the short to medium term compared with something like iron ore, which is going to have a precipitous drop off?
well, I haven't been following where those prices are at, so I can't really. Things like lithium, I don't track on a day-to-day basis. I believe it's fairly high, but I'm not sure. The answer is I would say they would certainly be stronger, but not particularly strong. But I can only comment in narrative terms because I don't specifically follow those.
The key one for me on lithium is the demand. I think demand is absolutely going to keep growing. That's where the sort of kernel of truth behind the whole, there is an electric battery revolution going on, and demand's going to keep staying strong. The issue for lithium is that the way it tends to get mined is in these really big mines where they can get really low costs. So it's sort of a bulk mining method. And so what that tends to mean is it's an absolutely typical commodity cycle where prices will push up until somebody finally bites the bullet and puts one of these new big mines on. And then prices will go up even further because the new mine isn't on yet and the demand's sort of still coming. And then prices will keep pushing up, and then the new mine will come on and just take the wind completely out of the sails of the whole market, and you'll see prices come crashing back down, and then the whole cycle will start again, where it's like, okay, who's going to be the next person to bring on a big mine? And at low prices, everyone just stands back and goes, no, not me, not yet. And they'll sort of set them up and do all the work behind, proving up resources, and then you get a new, prices will ratchet up to the stage where somebody goes, yeah, okay, that's high enough. I'll actually take a bite at it. So we're in this stage now. I guess the thing for lithium is, if you want to be in there, play the cycle. Absolutely, go for it, go for your life, but don't sit there and expect that the lithium price is just going to go up and up and up forever and ever, because there is a lot of lithium around. It is something that gets mined in really big mines when it happens, and so as they come on, you will see prices fall back.
They had asked
This
specifically
is why
about.
it's important to note. This is why if you're playing miners over the cycle, you really want to be buying them when they're expensive, not cheap. Right now they're all very cheap, but it's because prices are so high, and it's when prices crash that they become quite expensive. But that's when low prices will cure low prices, and
capital expenditure, though, that's the other big one to watch. When they've all been spending lots and lots of money on capital expenditure, then you're watching and the mines are all coming on. That's the time you don't want to be involved in it. But when everyone's been stepping back for a few years and not spending on capital, and no new mines coming on, that's when you've got a window.
Yeah.
Sorry, Jayden.
And this viewer had also asked specifically about aluminium. If you guys had any thoughts specifically on aluminium.
Well, I mean, that's a really short-term thing in China at the moment, at least, because I mean, look, I'm not an aluminium expert. I'll just comment quickly on the fact that Chinese have rationalized a lot of production because of their energy crisis. They're knocking out, a bunch of producers in not just aluminium, copper, and steel as well. They're trying to just limit energy consumption wherever they can, which is another interesting dynamic in terms of buying commodities, because you can see that sort of certain refined metals are finding themselves in more shortages than they would normally, because China's been forced to rationalize supply on the energy prices. But again, it's very short term, and so
And it also means what's coming out of the mine is not necessarily getting the same price kicker, because what's coming out of the mine then gets delivered to somewhere that's not produced, that's been shut down, and so they're building up their stocks, and then it's going to other places, and the difference now between the sort of raw bauxite that you're getting and then the cost once it's been turned into aluminium, a lot of that has gone into just paying the extra electricity prices, which have rocketed up in the short term. So so I guess it's coming back for those ones is the whatever prices you're seeing for those, keep very much in mind that there's a lot of these short-term issues going on where you'll be able to see price spikes and double and triple and then fall back the same amount as soon as that clears. But I think the overall demand picture from our perspective is there's a lot of problems going on with building within China, they've been the big swing, I guess, demand factor over the last 2 decades. That's really risen in terms of the gone from almost nothing to being the largest consumer of all these, and so that doesn't have to fall back very far at all to really hit the amount of demand that's needed. And so absent, I guess we're sitting in this part where the longer term line is headed down for this demand, based on our view that China's housing really is slowing quite dramatically in terms of and they will go back to a more sustainable amount of building, and so you're going to get these short term disruptions because of imbalances, but the longer term trend is certainly for it to be down. So if you do want to play those, be ready to grab a seat when the music stops. Don't be dancing too far away from a safe seat.
What do you, if you got at the moment, the shakeout looks like it might hit, if you include infrastructure, which is also struggling. I mean, of course, they can stimulate and improve this, but at the moment, it looks like maybe China's construction could fall by 25% over the next year. And that would mean, about roughly 70% of, like
between 5 and 15% of global demand for most commodities.
I'd say. It's 20% of China's steel output. That's 200 million tons of steel. It's 300 million tons of iron ore. And
China's steel output is bigger than the rest of the world combined.
I mean, it's a huge amount of copper, nickel, all sorts of everything. So, if that happens, then it's just all bets are off. So our base case then is that is what happens. Not that necessarily those numbers are right about China, but there's enough for the underlying surplus of commodities to reimpose itself before terribly long, especially when the energy bubble bursts. So we're talking, kind of into Q1 next year at the latest, the end of the Northern Hemisphere winter. And so 2022 for Australia, right, we've obviously had this fantastical kind of iron ore crash, the largest in history, in magnitude, not in depth so far, but that'll likely continue. And I'm talking potentially 2015 lows next year, on the basis that China continues to let the property shakeout transpire. And the entire commodity complex kind of following it into deflation, and so that deflates a lot of all of this stagflationary concern around the world. But for Australia, it represents a ginormous income shock, so as that sort of deepens as the year goes on.
So let's move on to the Australian, what's happening to Australia.
That's what I'm doing. And we're already doing some tightening ourselves, because property's overheated, so we're going to see some macro-prudential. And it looks like the moment they open the borders, they're going to recruit every warm body they can as a migrant. So, in terms of stagflation for Australia, it's not even on the horizon. These three things that are coming next year are going to crush Australian inflation. and we'll be back to low inflation with a bullet. So I mean, the RBA may therefore get through taper, but 2024 rate hikes at the earliest, and it may well be forced to print before we get there. For instance, if we did replicate the 2015 commodities bust, the only thing that got us over that was another housing boom, and so the RBA may be forced back into easing relatively quickly if those various negatives combine. So that's Australia and stagflation, just not going to happen, we don't think. In broader investment implications, so I think the commodities energy bubble bursts relatively quickly. The Australian dollar right now is got the tiger by the tail, and the market is the most short the Aussie dollar it's ever been, at least in terms of net shorts, in terms of volumes on the CFTC. So obviously there's scope for a squeeze while this energy bubble goes on, which does completely offset the iron ore crash that we've had while it lasts. Coking, thermal coal plus LNG.
So what David's saying, just to interpret that for anyone, while we've got the Aussie dollar falls sort of as one of our key things, there's short-term risks to this as if the this energy bubble keeps going.
Yeah, so long as the energy bubble can go, the Aussie dollar can keep going up, is what I'm saying. But once it all comes apart, the Aussie should fall away, possibly very quickly. At the moment, we've seen pretty decent backup in long end, that is long duration bond yields worldwide, and so that's telling you that inflation is coming over a longer time frame. But we expect that will just roll over as well as the energy bubble bursts. By the way,
particularly in Australia.
Particularly in Australia. And by the way, it's not necessarily the case with oil. Oil's not really the key commodity here. In fact, oil is massively underperformed in the energy bubble. It's gone up, maybe 20% in the last few months, whereas some of the coals and LNG are up 500%. Crazy kind of stuff. So 300% and 500%. So oil doesn't need to crash for this to happen, and it may not. Depends what OPEC does, but I would expect if China really it does effectively stop growing, that oil will roll over as well. And we expect this to sort of form the core of a reasonable stock correction as well. You'll have the Fed tapering and then looking at rate hikes. The market's already got rate hikes priced for next year, 2 of them in the US. So at a certain point, it's going to have to be made clear to the Federal Reserve that's not a great idea. And the best way to do that is for the stock market to sell off. So we've been expecting a correction for a few months now, and that still looks likely to us. But we don't see this again as any kind of stagflationary bear market. We don't see stagflation coming. What we're really just seeing here is stimulus and COVID and pandemic distortions, and the stimulus pulses that we've seen now. Really since, I suppose, 2018, when Jay Powell did his great backflip from tightening, both in terms of QE and fiscal. Those pulses are around where you get inflation and where you see some inflation as currencies rise and fall, especially when it's the Fed and the US dollar, and commodities can inflate and deflate. But that's pretty cyclical and pretty typical of what we've seen for the last 20 years, rather than this step change that people are worried about in terms of a new stagflationary environment. And so a decent stock correction. And then if we get the good commodities correction, then we're back to a relatively Goldilocks scenario for stocks and bonds.
Which is that low interest rates, not strong enough to really rise too much, but enough that
Yeah.
and weak wage growth, which then feeds into better profitability for stocks.
I mean, there is one thing that I'd say that would be different to the previous cycle in that, and that is, and this is why, but this is a lowflation argument in effect. In the previous cycle, we saw a weak US for much of it and a very, very strong China. And the coming cycle will see the reverse, a stronger US and a weaker China. And that's actually a very, very deflationary setup for markets, especially commodities, if the US dollar is going to remain higher for longer. And, commodity intensive growth is weaker versus less intensive growth, less commodity intensive growth when you have the more services oriented economy of the US instead of China being the locomotive for the global economy. So that gives you a framework, if you like, where it will be difficult for any kind of inflationary environment to take hold.
Very good. We've got a few viewer questions here if you'd like to field those now.
Sure.
First one from Jude, which we were actually discussing in the green room of this episode. The New South Wales Premier Dominic wants to bring 2 million mass migration in the next 4 years. Thoughts? And is that his first number, but the feds will settle for 1.5? So sort of meeting in the middle there.
Well, my first thought is buy houses. And my second thought is I don't understand why Australians don't just riot. Because, if they're prepared to riot for the right to catch COVID, then they should certainly be prepared to riot over the imposition of falling living standards by a corrupt elite, which is what, in effect, this policy is and has been for 10 years and would continue to be. But it looks like it's a consensus that cuts across every parliament in every party in Australia for a number of reasons. It's kind of the wokeism of the press. The press itself has a vested interest in this because they are all wedded to the last growing asset in their portfolios, which is real estate services. And then you have an extraordinarily powerful growth / migration lobby that includes banks, retailers, construction. The unions don't fight it because they're so dominated by CFMEU types that love the construction that comes out of it. And the truth is, it does give you a type of growth, no doubt about it, but it's a very narrow growth with very narrow winners, and the narrow winners do not include households for the most part. So there's a lot of powerless losers versus a narrow set of very powerful winners. And Dominic
It'll keep
Perrottet.
wage growth low.
Sorry.
It'll keep wage growth low, which sort of feeds back into what we're talking about here, which is
Yes.
until you're not going to get stagflation if you can't get wage growth.
No, you're not. You're just going to get what we had in the last cycle. You're going to get secular stagnation.
On the front of why households don't riot, Dave, do you think there's a lack of knowledge of the actual effects of mass
No, I don't.
migration?
Most surveys are 60 to 80% against increased population growth and big Australia. None of this has a single bit to do with race, racism, ethnicity. Nothing. It doesn't. It's not an ethnically based resistance at all. Like, it's not white Australia versus migrants. It's none of that. Very often it's migrant communities that are against it. It's simply the case that it kills living standards via weak wages, high house prices, and crush loading of public amenity. Everything from hospitals to freeways. And you know, we've just been through it for 10 years. Everybody lived it. It took MB probably 10 years for it to persuade everyone of what was really going on. We did it very successfully in the end. We won the argument hands down, but it just
the
doesn't.
Reserve Banks come out and basically
we
tick the
even
box
won
of
over
everything.
the Reserve Bank, but in the end, you know, the political class is captured by it financially, rhetorically, you know, I suppose ethically, they're in their own value systems, ideologically, they just, it's all I say. We've just had 10 years of all the negatives. We had a pandemic in which we actually had some wages growth. A lot of those negatives that came out of immigration disappeared. And yet, you know, the first thing we want to do is go straight back to it. And so, you know, we're going to waste a good crisis.
But it's probably worth saying as well in terms of the this idea that the more if we keep pumping more people into it, if the political view is to pump more people into it, there are ways they can hide it and pretend they're not doing it, which sort of gets rid of a lot of the gets rid of a lot of the complaints. So you can be extraordinarily cruel to one particular class of migrants, for example, that come by boat. You can have these temporary visas and student visas and things like that sort of hide the actual permanent amount. And so there's all these little tricks they can use to convince people that no, immigration isn't as bad as what you think it is. But then, you know, with the true numbers being as high as they've sort of ever been. And but the other one I was actually interested in is which is it's an unknowable thing at the moment, but I think it's worth recognizing the risk is when Australia last really threw its borders open following the financial crisis. Australia was one of the few countries that was actually growing, and so it was a little bit of migrate to the country which has got genuine growth, and you'll get a job. So if you'd lost your job in the UK or Europe or the US and you're an Australian citizen, or you wanted to you always thought about coming to Australia, there was a bit of an impetus to come back to Australia. The question in my mind with the crisis is following the pandemic is I think there's a renewed sense of vulnerability among people, especially in terms of work. And so the question will be for people are saying, well, if I did move to Australia and there was another crisis, another pandemic or something like that, what would happen and I lost my job, what would happen? Would I actually have family or friends that I could actually fall back on? And would the government support me? And the answer was largely no for a lot of the Australian students within Australia who were sort of trapped here and lost their jobs and weren't eligible for support and things like that, and didn't have family and friends they could fall back on because they just don't have the same networks. Maybe that means that when they do open the borders and say, you know, come all, they might not get as many people as they think. So I don't know if that's true or not. Maybe they'll just go down you just keep going down and saying, well, let's just bring in more people from third world countries. But that's still a big unknown, I guess, from my point of view.
So do you have another question, Jayden?
Yes, there's one here. With gold being down in a strong USD environment, or is gold going to go down in a strong USD environment, or do you see some form of inflation hedge there medium term?
Well, two things I guess I would say is no, I don't think gold's a good play at this point for that reason. Stronger US dollar and as commodities deflate, I think we'll see rising real yields. And so that's a bad environment for gold. And second, gold has barely reacted at all to the US inflation scenario. In fact, you know, it was far, far stronger when we faced a deflation scenario last year. And whereas Bitcoin has been super sensitive on both occasions, And it just looks to me like enough money is playing inflation trends in Bitcoin for gold to have effectively been neutered. And so I'd be a bit wary of gold in terms of playing it on those factors. But then, unless they became very extreme, in which case I would expect gold to replicate, some of the things Bitcoin's doing. But for the time being, it just looks like gold has been knocked on the head by crazy crypto.
Fair enough. Replacing it. Got a few questions here about iron ore, so perhaps just some quick answers, given we did touch on that for quite a while. One person's asking, do you maintain your position that the iron ore price can be US $60 in 2022?
Absolutely. In fact, I'm getting more bearish. Yesterday, there was a very extraordinary flow of news from China and this new kind of pogrom unleashed by Xi Jinping in the financial regulators and the major policy banks. This is like the biggest 24 banks, publicly owned 24 banks in China, and there's, the I can't remember what it's called. Do you remember what it's called? The centralized Bureau of Discipline or something?
Yeah, it's a very Orwellian name.
Yeah, there's this great Orwellian name for sort of Xi Jinping's shock troops for anti-corruption, and they're all headed out into the major banks to ensure that they're not corrupt and lending to the wrong people, which in this environment means developers. And that is those banks, those policy banks are the key, I suppose, lender of last resort in fiscal, in monetary terms, in the Chinese economy. Like, they're the ones that go out and say, okay, well,
when the sky's falling, and
the sky's falling, we're
going
to lend to whatever the hell you want to build. And they've 5 minutes, and they've all been they're all getting curtailed by an anti-corruption push, which is incredible, because only 2 weeks ago the PBOC dragged them all in and said, make sure property is stable. Well, that's not going to happen now. So
and it's very analogous to the Australian Royal Commission, where
it kind of is
Royal Commission going on, and the banks didn't want to lend because they're like, well, we're not quite sure what the rules are and whether, what the new rules are going to be. And so let's just sit back and wait and see what happens.
Well, with the added frisson that you might be executed in a public stadium.
That's right.
If you get your lending criteria wrong. And so this has just got me pretty excited about, and not, excited in the sense that hyperstimulated, I suppose, is probably a better word, about what this is going to do to the shakeout in developers. I think it makes it considerably worse, and with no end in sight. I wouldn't call it policy error, but there's clearly some confusion in China at the moment about who's doing what and when for the developers. I'm not saying it's going to, I don't think it turns into a GFC, as it were, but it's certainly going to hurt China. And so, and in particular, it's going to hurt iron ore. That's a long-winded answer. And so I actually think next year we could challenge the 2015 low, which is like $38.
Very good. Thank you for those.
So yes,
Dave.
I'm very bearish on iron ore.
There are some more questions there, but it looks like it's time to wrap up with your wife or whoever that was asking you to come on. Okay. Very good. Anything else from either of you gentlemen?
No, thank you.
No, leave it at that, I think. Thanks, Jayden.
No worries. Thank you both for joining me today. Just quickly, a shout out to our viewers. We've got our viewer question of the week here. The question is, what signs of inflation are you seeing in the markets? So please let us know in the YouTube comments below. On that note, thanks to all of you viewers for tuning in and watching the episode live, and all of you who have asked questions. Apologies we couldn't quite get to all of them, but we appreciate it nonetheless. As always, we welcome your feedback on this episode and the show, any topics or guest suggestions you might have in the future. Finally, don't forget to click like on the video now, share it with a friend if you like, subscribe to our channel, follow us on your preferred podcast platform. If you'd like to see more of our content, you can head over to nucleuswealth.com/content or catch us on our social media channels, which you can share on the screen now. Thanks again for all of you who have watched in live today. We appreciate it, and thanks to the hosts.